Apart from reading an issuer's official statement or attending an investor presentation about an issuer's proposed offering, investment decisions about municipal bonds typically require additional information from certain organizations in the ecosystem in which these instruments are issued and traded. Beside the fundamental factors that investors may use to assess the risks associated with general obligation bonds and revenue bonds, institutions such as municipal guarantors, as well as credit rating agencies such as Moody's Investor Service, S&P Global, and Fitch Ratings, each play a role in the issuance and trading process. For example, certain credit rating agencies typically use a scale to categorize the creditworthiness of most issuers of municipal debt, as well as their debt offerings, with designations usually divided into investment grade and lower quality credits. Ed Grebeck is a strategist in the global debt markets and an expert in the bond insurance and rating agency industries. He's given one of the earliest warnings to investors of the global financial crisis. Welcome, Ed. Thanks so much for being here and joining us on IBKR Traders Academy for our municipal bond course.
Thank you, Steven. I'm glad to be here with you today in Greenwich.
It's great. It's great. Thanks. It's really great to have you here. Before we get into the bond guarantors and rating agencies, which I understand you hold largely responsible for their roles in the global financial crisis, can you tell us a little bit about the difference about investing in, say, fixed income products like municipal bonds versus, say, equities?
Yeah, great. I'd love to. Basically, with equity investments, shares, individual investors can do their own research into each individual company, and they're doing it with the hope of finding one of the gems that's going to rapidly increase in value. And they also want to make sure that it doesn't collapse in doing it. So they have to do a lot of research, and they can do that. With respect to the bonds, it's quite different. All they're hoping to get is they're going to invest 100, say, in a bond today. The only thing they can get is basically that 100 back plus some interest over the period.
I see. So it's like capital preservation.
Yes, bonds are capital preservation.
I see. That's fantastic. On that, can you tell us about then the context in which this investment works in light of bond guarantors and credit rating agencies, or simply what are their roles, what are their capabilities for investors?
Well, the first one, let's take the rating agencies. The rating agencies make an effort to do that fundamental research on each individual bond. In the case of municipal bonds, what they'll look at is basically the official statement issued by the state or municipality. They'll look at the bond documentation, and then they'll also look at the overall macro environment. Is that state or city attracting profitable industries? How is local employment or unemployment? Are people moving in, moving out, etc.? And in aggregating all these factors, they'll come up with a rating. Is it AAA, which means it has hardly any risk, and so on down the continuum, down to like a risky, let's say, CCC rating, which means that there's a lot of speculative possibilities regarding payment.
I see. And bond guarantors, what is it they do?
Well, bond guarantors basically will ensure that the investor gets paid back principal and interest pursuant to the terms of the documentation if that state or city defaults. It's important here to bear in mind, though, that the bond insurers are creatures of the rating agencies. The rating agencies will basically give the bond insurers a rating. Right now, the highest rating that they give is AA. And they will require the bond insurers to invest only in bonds that they determine are investment grade. That said, they will not force the bond insurers to do that. However, they will set up the capital charges that influences the bond insurers' investment grade AA rating based on what their investments are. So, for example, if the bond insurers guarantee, let's say, an A-rated or AA-rated credit, they might allow maybe pennies on the dollar of capital. If they were to guarantee a double B rated investment, they might require several dollars of capital per 100 of guarantee. So they basically determine one way or another what the bond insurers invest in.
I see.
The guarantee.
I see. So given the roles and capabilities of the rating agencies and bond insurers, I know that you hold them largely responsible for their roles in the credit crunch of 2008, 2009. They're still in operation today, and investors are still using them. What is it that investors of municipal bonds would need to look out for that you saw back in 08 and 09?
Well, I think the situation with respect to the muni market in particular is that the bond insurers have hardly any capital relative to the muni risk that they have guaranteed. It's sort of like it's probably you could say during the credit crunch before the credit crunch they were capitalized at around $110 of guarantee for every dollar of capital that they held. Now it's maybe slightly less, but it's still fundamentally there. It's still there's still very little capital. I think the real problem, though, is what's happened in the muni market in the last, say, 10 or 20 years. I imagine that there's a lot more political and governance risk with respect to U.S. state and local credits. That arises from, among other things, unfunded pension liabilities. Kentucky is the leader in the biggest unfunded pension liabilities in the states.
And these are not something that the rating agencies would capture in their research or analysis.
They can capture that. However, there are other issues there as well in the muni market. For example, like in the case of New York State budget in 1978 was $16 billion. In 2019, 2018, it was basically $175 billion. That's a growth rate per annum of about 6% over 40 years. I mean, can you imagine any businesses that have that growth rate over 40 years that are successful? And New York State, in terms of population, has been pretty much stagnant in that period. It grew from about 17.5 million in 1978 to about 19.5 today. That's an annual growth rate in people and population of 0.25%. I mean, what business would actually grow that fast when basically the economy is shrinking? That's what I call governance, political risk, etc.
And it's fascinating. It's really fascinating. And I know you mentioned unfunded pension liabilities. It sounds like there's a whole lot more than just
there is a lot more. Political risk will not be found in the official statement. It's something that you, the individual investor, has to get by just reading the local papers and doing your own street level research on the political side.
I mean, it sounds like there's not just one governance risk. It sounds like
there are several.
It's really fascinating, and I hope that you will come back with us and provide further insights about all of these different kinds of governance risk. It sounds like they're proliferate. It sounds like there's a lot of them. It's great. Either here at IBKR Traders Academy or come back with us to speak with us on our series on U.S. muni market on IBKR Traders Insight. I think that'd be great.
There's a lot more political and governance risk out there in the muni market, and I look forward to investigating more with you.
Ed Grebeck, Global Debt Strategist, CEO of Tempus Advisors. Thanks very much for coming.
Pleasure to be here, Steven.
Thank you very much. Great having you here. In our next lesson, we'll show you some ways you can search for municipal bonds using the IBKR Trader Workstation, as well as research tools that provide you with useful intelligence when making your investment decisions.